So good morning guys. Today we'll be talking about divergence, moving averages, and I'll be skipping the Fibonacci because we will not be making use of it. So I'll only be talking about divergence and moving averages. Divergence and moving averages, that's what I'll be talking about. So the first thing first is this: divergence. There are simply two types of divergence. We have the regular divergence and the hidden divergence. Now the hidden divergence is a continuation of trend. I have not really focused on the hidden divergence. I have not done that, but I will do that later on. But one thing I want you to know is we are going to focus more on the reversal of trend, the retracement of trend, and that is caused by what? The regular divergence. The regular divergence. Now, in divergence, there are two things we have to know about: the price region, which is this place. Yeah, this price region, and the oscillatory mode region. Now, before we do that, I would like to put our MACD. This is what I used for my divergence, and this is our oscillatory region. This is our oscillatory region. Now, I'll take out the volume indicator. Good. Now, this is our oscillatory region. Now, these are the two things we use for price divergence: the price region and the oscillatory region. Now, the price region is wherever you want to see your price, where your price is, you all know that, and your oscillatory region is where we play our indicators. Now, what we use is RSI and MACD. I love MACD because MACD to me is very smooth compared to RSI. RSI shows us a lot of zigzag and whatsoever. So I don't want to make use of the RSI because I use MACD 99% of all time. The only 1% I don't use MACD is when I put in my RSI into the chart like this. Then it will look like this. Relative strength index. Yeah, this is it. Can you see the difference? You can see I don't like all this tiny. To MACD is just so straight, smooth, and that's why I love about MACD. So I'll be removing the RSI. Now, quickly, we're making use of our trend line to spot divergence. Now, whenever you want to spot divergence, you want to spot divergence where? At the price region and the oscillatory region. What is divergence? First of all, divergence is when two objects are diverging. Two objects are diverging. They are not actually going in the same direction. That is what divergence is all about. So in this case, price and oscillators are diverging. They are going different places, separate places. They are going to their separate places. And so what happened when this occurred? Divergence has taken place. Now I will spot the bullish divergence and the bearish divergence. Then you people will take it as an assignment and do the rest. Now I'll be picking divergence from this region. Now, in looking for a bullish divergence, you need to have what? You need to have these two things in place. For the bearish divergence, higher highs, two higher highs. Price must make what? Two higher high. Can you see? Two higher high. And when price is making two higher high, the oscillators is making what? Higher high. This is the higher high at the first region, and instead of it to make another higher high, is making a what? An higher low. It's making higher low. This is it. So it's making a lower high rather. It's making a lower high. This is it. It's making a lower high. It's making a lower high. So what you do is what? You plot your trend lines like this, like this. This is your divergence. As simple as this. For a bullish divergence, this is a bullish divergence. Combination of price, which is this area, down to the combination of oscillator and the combination of these two places. This place is what we call divergence. Divergence has occurred. We have divergence here. This is divergence. This is pure divergence. Now the next thing we want to look at is what? For the bearish side. Now for the bearish side, you want to look spotting what? Now if you look at this, divergence can happen for so long, just like we have here. I'm going to take this example. We have this for the bullish divergence. No, this one is for a reversal trend for a sell, while this is for a reversal trend for a buy. Now look at this. For the sell, we spot what? Two lower low. Lower low. This is the first thing. Our lower low. Another one, lower low. Then we have this here, our lower low at the first place. Then here, instead of us to have a lower low, we have a what? Higher low. Now we connect our what? Our trend line. This is divergence for you. This is divergence for you. Now this is another one. Now I can say this is an I instead of an higher I. We can still say we have a I. My H stands for I, please. And we have a what? Higher I. And instead of the price to make what? Oscillator to make what? I. Instead is making a what? A lower high. It's making a lower high. And this is what we have. We are having this. We are having this instead. We are having this instead. Are you seeing it? This is for what? A bullish divergence. The causes reversal. This is what I love using. I don't check divergence for a continuation. I check divergence for reversals. Now this is it. We have this. We move again. Let's keep on spotting them. Good. We have this. We have an I here. We have another higher I. It's not complicated. You just keep it very simple. Now oscillator is making what? I and what? Higher low. Higher low. And that is why we have what? That was why we have this particular close down. See? Price went bearish. Price went bearish. Now this is that on divergence, but I would like us to enter the part 2 on divergence, and that is what I want you to understand how to confirm a divergence. That is what we are doing next. How to confirm a divergence. How to confirm divergence. Now one thing you need to understand is this: divergence work with what? Time frames. It works with time. It works with times. Your confirmation must come from the time frame. Now your confirmation must come from the close of your time frame. Don't forget, your confirmation must come from the close of the main time frame. Of the main time frame. Your confirmation must come from that zone. Your confirmation, you want to see your confirmation from the close of the main time frame. If it's not from the close, then you are not having a divergence that is confirmed yet. You are just having a normal divergence. It is a confirmed divergence that has been confirmed, that will make price to reverse, and not just ordinary divergence. Now what am I saying? Look at this region. From here, where we see my okay, let me look for a better one. I need to look for a better one where we have time and price. The time and price theory. need to see a better one. No, this is not a better one. Yeah, this is a better one. Now look at this. This divergence started from this point, yeah, from this low, as you can see, and this was the low. Now some people will say, wow, we have, when price made another lower low, yeah, when price made another lower low, yeah, some people will say, wow, we have a divergence. Yeah, this is divergence. It is what? Equal. So it is a divergence. They are not price. Oscillator is just stalemate. That's why I wanted you to see this. When oscillator is stalled or price is stalled and the other one is making waves, then this is divergence. Remember, the core essence of divergence is what? When two of them did not agree. The core essence of divergence. Core essence of divergence is what? When there is what? A disagreement. When there is a disagreement in price and oscillator. Now if you agree with me fully well, when price is going upward and oscillator refuse to go upward, we are having a what? A divergence instead. So just know that the essence of divergence is what? When price do not agree with oscillator in its movement. Now let's go back to what I want to show you. We have this here, the divergence here, but if you look at it, some people will say, wow, this is a divergence, let's start buying. Fine, they bought. They said, okay, this is a daily divergence, it's going to last for more than 1 month. Let's say we are going to target back this up. Fine, they bought, but what happened? Price went here and dropped, made another what? Another low. Price made another low, and what? We still have our divergence. Can you see it? If I carry this particular line now and stretch it, you will see we still have our divergence. We still have the divergence. And let me extend this one. We still have our divergence. We still have our divergence. Now that is why we need a confirmation. We need a confirmation. We need confirmation. Confirmation to do what? To buy or to sell with divergence in alignment with what? Time frame. We don't just want to buy. We don't want to buy or sell because we've seen a divergence. No. If you look at it, what happened here? It is because of we did not see a confirmation at this point. There was no confirmation at this point. That was why price did this. Price went higher like this. Can you see? And drop. It formed a divergence. Can you see the divergence? It formed divergence. This is the high. And this was the higher high it formed. Although it's the second higher high, but let's just make use of this. And we have what here? We have a high. We have our high. And we have our what? We have our lower high rather. Now can you see? And because of this divergence was confirmed, it was confirmed with the monthly time frame. It was confirmed with the monthly time frame. Then price drops. Can you see? It drops drastically, and it did not make another divergence from this zone. Instead, price continue is what is bearish trend. Now that will take us fully well to what? To the confirmation. How do you confirm your divergence? Now, like I said, we confirm divergence with time, with your time frame, your main time frame, your primary time frame, and your main, primary, and your entry time frame. That is why we confirm the what? The time frame. We confirm divergence with the time frame. Now, wherever you spot your divergence, listen and listen good. In terms of divergence, there's a change in the main time frame. In terms of divergence, there is a change in main time frame. And what is that change? Where you spot your divergence is the main time frame. Is main time frame. You get the point? Good. Now, where you spot your divergence is the main time frame. Sorry, where you spot your divergence, let's just continue. I don't want to tamper with your brain. Let me just use this way. Where you spot the divergence is your primary time frame. Your primary time frame. Now, when you have spot your divergence, that is this. Look, listen to and listen good, please. This is very important. It's very, very important and critical. You have to understand this. Where you spot your divergence is the primary time frame. Remember, we are doing what? How to confirm a divergence. How to confirm divergence with time frames. That's what we are doing. Now, where you spot your divergence is the primary time frame. So you have to spot your divergence first of all. That is your primary time frame. Now, when you spot your divergence, now in this case, we are going to make use of this scenario. This one, we want to know why this one did not work out and why this one worked out. You get? Good. Now, in spotting our divergence, what happened? Since we say where we spot the divergence is the primary time frame, so daily is our primary time frame. Now, switch over to the main time frame of your primary time frame. That is where you want to see your confirmation from. Switch over to the what? Main time frame of your divergence time frame. All right, let's use divergence time frame. I love the English. Let's make use of divergence time frame. So where you spot your divergence is your divergence time frame or your primary time frame. So let's have it like that: primary or divergence time frame. So this is where you are spotting your what? Where you spot divergence, your primary or your divergence time frame. You switch over to the main time frame of your divergence time frame. That is the second step. Now, what you want to wait for is what? The close. This is important. The close of the main time frame. The close of the main time frame. Now, at the close of the main time frame, you want to see something, this, and break in market what? Structure. It's very important. And break in market structure. Very, very important. It is important as. Now, these are the four rules. These are the three rules rather. You want to spot your, how to confirm your divergence. You want to spot your what? Your primary time frame. Let me edit this. So I thought how to confirm divergence. How to confirm divergence. Good. You want to spot your divergence in the primary or divergence time frame. Then you switch over. Okay, let me turn this to when. When you spot your divergence is your primary or divergence time frame, then you switch over to the main time frame. Now let's switch over. First of all, we want to take note of this particular area, part A, why it did not work. Part A. Now remember, we want to see a break of market structure from the main time frame here, which is this place, and a close at the end of the close of what? The main time frame. Now since we have daily as our primary time frame, our divergence time frame, we want to look out for what? First of all, we locate if there is a break in daily market structure here in daily time frame. We've seen our divergence. Now this is the market structure region. Here price drops, went up. Now this is the market structure region. This place, this is the region that acted as support. Now we'll now go to the week, the monthly time frame, which is the monthly. Okay, this is it, part A. Now at the close of the monthly time frame, can you see how the monthly close? This is what we have here. It turned out to be a week. What we are looking for is what? If this bull candle, if what we are looking for actually is what? We are looking for this particular candle here to go like this. Good. We are looking for this particular bearish candle that acted as a week to close as a bullish candle. Let me turn this to blue so you understand what I'm trying to say. Good. To close as a bullish candle up like this. Wanted it to close as a bullish candle above our what? Our market structure at the end of the month. This particular candle, this one where my crosshair is. But instead what we had was a week. So because we saw a week, it did not what? Close below above it at the end of the month. So this is how we confirm the divergence. So for you, that divergence is not what? Is not correct. It is not the correct divergence. So what we have to do is what? We overlook the trade. Can you see? Don't forget, let me take it one more time so you get the point. We spot our divergence. We spot our divergence where? At the divergence time frame, the main primary time frame rather. This is it. At this zone. This is where we spot our divergence. Now the next thing we look out for is what? A break in market structure. Yes, we have the break. But at the end of the month, we have to wait for the end of the month. This is daily, the end of the month to confirm. And how do we confirm? We need a close above this market structure region. And we did not what? Have it. So there was a what? A change in direction. Market started moving back, dropping. Did you get? Now let's now go back to this. How did this confirm? Now we have the divergence on the daily. Don't forget, we now go back to our what? Look for the market structure region. This is the market structure region. This zone. It's actually the market structure region. Yeah. We want to see a close below this at the end of the month. Now let's go to the monthly, which is our daily, our main time frame for our divergence time frame. Can you see? We have the close. And where is the close? This particular bearish candle. This particular bearish candle closed below market structure and went ahead to do 2 more days of what? Sellers. So this is how to confirm your divergence. Don't forget these rules. Practice it. Eat it. Study it. Because this is one important aspect in Forex you need to understand. Practice and study it very, 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 very well. If you are not getting it, ask your question. After in our live class, we'll discuss more on this. So study this very, 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 very well. Now that is all on divergence. We'll move down to what? Moving averages. Now, moving averages. What I use the moving averages for? On a normal, they use it for what? Buying and selling. In the sense that people buy when price crosses above moving average, and people sell when price crosses below moving average. Now, how do I use moving average? I use moving average like this. I don't use it for a buy or sell, cross above, cross below. No. I used it for what? 1, to checkmate my entry, and 2, at a key level area, support and resistance area. Good. Now, when we get to the trade, taking a retracement trade, I'm going to tell you how moving average work with what? Time. But for now, just know that I make use of my moving average for key level areas and what? Confirmation to align my entry, in the sense that I don't want to sell if price is above moving average. That means in as much as price is above my moving average, I don't want to sell. Price must be below my moving average and give me my entry signal, then I sell. Price must be above my moving average and give me my bullish signal, and I buy. Take note of that. Take note of that. Let me write it down. I buy when price gives me an entry formation above moving average and I sell when price gives me an entry formation below moving average. Below moving average. Now this is it. This is what I do. Don't forget, I don't buy when price crosses below moving average. No, I said price gives me an entry formation, so I must wait for that entry formation before I would enter. And price must be above if I'm buying, and price must be below if I'm selling my moving average level. So please understand this for now. In the next class, we will go truly into key level areas. Thank you. Please subscribe. Thanks for watching. God bless you.